If you opened up a tax bill this year that was $5, $10, or even $15,000 more than you expected, you're not alone. And in most cases, something like this is actually reversible. But how do I know something like that? Because the first thing that we do with all of our new clients is show them how they can reverse the mistakes of their prior accountant and get back thousands of dollars as a refund. Now, I'm gonna show you the 3 most common reasons that business owners get blindsided in April, exactly which scenario is most likely yours, and the specific steps that you can take to amend your tax return and claw back your money that is sitting with the IRS right now. Then I'll show you the system that we use in our firm so that this literally never happens again. No surprises, no panic, and no notices. I'm JT, and about 40% of our clients came to us last year after a tax disaster like that. Last year, we filed amended returns that recovered thousands of dollars for our new clients. And in this story, the IRS is not the villain, the prior accountant is. So if you got a surprise tax bill, click the link in the description of this video, apply to work with us, and get on the calendar ASAP. Now, the number one reason why people get surprised, and especially business owners get these surprise tax bills, is that they're missing business deductions on the return, and they normally think, God, man, I thought my CPA was doing that. I gave him everything. But a lot of times when you just go to your accountant in April, the accountants are just gonna copy and paste, sometimes do it like last year. So you don't really know. But I wanna give you guys a way to check that. Because again, you guys are business owners, you're making money, you're hustling. It's not like you're sitting around saying, oh, my tax, or every time I make $1, I save 30 cents in tax, or expect to owe 30 cents in taxes. Nobody's thinking that way. All right, so we want to equip you with ways to look at that. And again, I'm going to show you a sample return of how to pick out things that are missing or things that might look off when you're reviewing it. And again, this is not to make you the next CPA or an EA or give you a master's in tax. This is just to give you some tools to be able to look at certain things that you can pick out, or that anybody could. Now, when you are a business owner, you pay taxes on your profit. That's all of the money in, or all of your income that you make, less all of your expenses, and you're allowed to deduct ordinary and necessary expenses. So think of things like software, like advertising, supplies, all of that stuff. So the first thing that we do with all new clients when we review their prior return is we want to look, obviously we'll ask them, what industry are they in? And you can look at your return. This is a copy of a Schedule C, but again, 1120 or S Corps look very similar to this. C Corps, partnerships, again, this is not to make you a CPA, this is just to show you kind of where to look. And you'll even see on here, profit or loss from your business. So the first thing that we do is we want to look at what type of industry they're in. Again, so this particular person, they are an electrician. And again, this is a sample return generated by AI, so this is not real. And the thing that we want to look at is what industry they're in. And then we want to look at their income. Because most of our expenses are a function of our income. Think of things like cost of goods sold, like your advertising, your car expenses, right? The more money you make, the more you're going to spend on ads, the more you're going to drive, et cetera, et cetera. So after we know what industry they're in, we want to look at industry averages. So for example, on this return, they made $407,000 in income, and generally you're going to be spending, at least in the trades a lot of time, about 5 to 10% of your income on advertising. When I look at this, I would automatically know that advertising is very low. This is like 1%. It should be about 5 to 10. Same thing with their cards, very, very low. But again, if you don't know where to look, you're not going to pick these things up that maybe certain expenses were missed. So in this case, I would go to the client and I would ask them like, hey, like how much do you spend on advertising? And they're going to say, well, I spend at least $2,000 a month on Google ads, and I do some Facebook ads, and I have an agency. And I'll say, okay, great. It looks like here you only reported that you spent $3,000. It's like, that's impossible. I know I missed stuff. So that's one way that we can look, is just kind of by checking if the expenses match. And again, I don't expect you to know what you spent to the penny, but you kind of have an idea. You know how much your rent is, you know how much you're paying your agencies. You're going to know things like that. And then we can scroll down here and you can do what's called an amended return, what we talked about in the intro. You can amend the return. Now looking at this looks way more likely, right? 407,000, 5 to 10%. This is way more within the range of what you would spend on ads, right? So then we know that we can claw this back. And now what you can do is you can amend the return and you can get some money back that you might have overpaid. Now again, you want to be checking these things, and we do this with all of our clients, is we send them copies of the return before we have them sign them. And most importantly, if you're a tax planning client, we're going over on Zoom with you. We are showing where the expenses are. So that way you can see if you're a tax planning client. If that's something you'd like, definitely click the link in the description above or below in the video. And again, that's the way that you're going to catch some of these surprise tax bills or at least do something about it. Now, the second reason that you get a surprise tax bill is sometimes you have what I call typos on your return. Now, what does that mean? I don't mean that you spelled your name wrong or anything like that. But when you file your return with the IRS, believe it or not, they actually know or have a good idea of how much income you made. They're going to get copies of your W-2s, your 1099s, investment income. So they're going to know your income, they just don't know your expenses. So what happens a lot of times is maybe you might make a mistake on the return, the accountant makes a typo, this and that, and you're going to get a notice similar to this, basically saying that you missed something. Now again, we're going to go to the face of the return. And again, this is to show you how to see your own tax return. This is not to become a CPA or start signing tax returns, just where to look. So again, most of the time, we're going to have an idea of how much income we make. So this is a copy of any normal return or any sample return. And you're going to see that. And it really just is like a checklist, right? It's going to say how much W-2 income. It's generally going to be on line 1, right? If you zoom out a little bit, you'll see, oh, this is how much interest income you had, how much investment income, so on and so forth. So before you sign your return, you want to get a copy of this from your accountant. You should be knowing how much income you're making. So for example, if you know that your wife or you has a job that makes $150,000, but maybe you see $105,000, you're going to know to check that and ask your accountant, say, hey, I think something doesn't look right here. And this will prevent a lot of notices, a lot of surprise tax bills, just by doing this. And again, this is not to become how to prepare it, how to read it, or how to prepare it and look for all these tax deductions. It's just to be able to double check, because you would not be surprised how many times you get typos or anything, and that can create a whole big deal. Now, number 3, one of the reasons why you get surprise tax bills there are missed strategies that your accountant asks you about. Now, if you're going to your accountant once a year in April, they're not going to be able to ask you. They're just going to give you a questionnaire, and they're going to say something like this. Like if we look here, they're going to ask you something that says, how much did you spend on ads? How much did you spend on contract labor? Blah, 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 blah. They're going to ask you all that, and you're going to tell them, and you're not going to know. But there are certain things that you can make tax deductible that aren't going to necessarily show up on your bank statements or anything like that. So the first one that people are going to have is what is called your home office. If you look at this picture here, this is the picture of a home office. Now, this doesn't directly come out of your pocket or go through your bank statement. This is going to be something that is deducted on a different type of schedule. And again, we try to tell our clients we meet with in the beginning of the year, hey, if you have a home office, make sure that you set it up. Make sure you tell us how much you're paying in rent or your mortgage interest or property taxes or anything like that. And again, if your accountant doesn't tell you about these, you're not going to know, and they're just going to copy and paste. Now, for the home office, all you need, it doesn't have to look exactly like this, but it has to be an area that is specifically for work, kind of like this, right? Like you're probably not going to watch Super Bowl in here, you're only coming here to work. The same thing. So as long as it's a dedicated workspace, you can deduct a portion of your rent, your mortgage interest, your property tax, and things like that. Now, the second deduction that most people don't know about is a car expense. So let's say that you run a digital marketing agency, and you don't have to drive everywhere, but sometimes you have to go to conferences. Sometimes you have to go here, go to the store, pick up stuff, right? Well, you get to deduct 72 cents a mile or 73 cents, depending on what year you're watching this in. You get to deduct 73 cents per mile that you drive. But again, this doesn't come out of your bank account. This just shows up on your tax return. Now, your accountant is supposed to ask you, but in case they don't ask you this, make sure you're sending this thing. Say, hey, JT, I drove 10,000 miles for work this year. Great, I will make sure to add that to your tax return. And a lot of people miss those deductions. Now, the next one is hiring your kids. Now, there is no law that says, hey, you must hire your kids, but it is a strategy that you can do. For example, instead of hiring maybe an office assistant or something like that, you could actually hire your teenage son, your teenage daughter, or even a little bit younger than that, and you can pay them to work in your business. The reason why I like this so much is that yes, it is a tax deduction, but it stays within your family. So for example, let's say that you want to pay your son $1,000 a year to be your personal assistant, or your daughter, or to do something like that. When you pay them $1,000, it is tax deductible to you, but the best part is they don't pay any taxes on the money that they get. And they can use that money for Little League, for going out to eat, for a Roth. They can do whatever they want, but they start to learn responsibility. And most importantly, it actually ends up really not being taxable because it's going to somebody in your family and probably money that you were going to use anyway. So it turns these into deductions. But again, your accountant isn't going to tell you that unless you know to do that. So now the fourth way is, this looks like a board meeting, is what I like to call the Augusta rule. Now what the Augusta rule says is that you are allowed to rent your house out to somebody else, charge them any amount of money that you want, as long as you rent your house out 14 days or less per year, all of that income is tax free. Now you might be wondering, well, if it's tax free and I pay myself, what is the difference? Here it is. You get a deduction on your business tax return for renting your home out your business. These could be things for like quarterly meetings, for filming content, for having team building events, right? Whatever it is that you want, you just have to charge a market rate. So let's say like me, I live in Des Moines, Iowa. The average home rents for probably $200 a day, maybe $300 a day. As long as I have comps available, you can do something like that. So where this goes is, let's say I can get an extra $200 times 14 days, I can get an extra $2,800 expense, tax deductible, and tax free to me. Now, if I pay myself a salary, my business deducts it, but then I have to pay income taxes, so it's kind of a wash. But this here is a complete easy one. And again, if you have to do it during the year. If you don't know to do it, you're going to lose out on that deduction. Now, the next one is retirement. When you contribute to retirement, that is a tax deduction in the year that you do it. Now, most accountants, again, aren't going to tell you this. You have to seek this out, and hopefully you have a financial advisor that is moving in concert with you. But if you don't, these things can get missed. And again, it does not matter what type of retirement account that you have. This could be a Roth, this could be a 401k, 403b. You can have any type of retirement account that you would want. Now, the last strategy that most accountants don't talk about is what's called an accountable plan. Now, an accountable plan is kind of what it looks like. It's a reimbursement policy. I'm sure you had a job before where you get reimbursed. Maybe you drove a little bit, maybe you use your phone for work, right? For example, me, I just have one phone. Some of that's used for work, some of that's used for business. Obviously, I pay with it with my personal account, but I'm allowed to reimburse myself. My business can write me a check or a direct deposit today for said amount, but you have to be doing it in real time. You can't retroactively go back and do it. You have to do it in real time. And again, the IRS, you have to be doing this in real time. So if your accountant is not working with you throughout the year, you might miss something like this. So this is an easy way that you can get back $5, $10, $15, or even $10,000 of personal expenses that you use. Now, they have to be legitimate, like your cell phone. You can't just make up a number and say, well, I have the coolest iPhone in the world and it costs $130,000. That's not gonna fly, right? Now, again, if this is something that you would like as an account or in your account to be walking you through certain deductions that you may or may not be missing and to be double checking your numbers, like in this tax return here, where we wanna make sure that you have all of your industry standards here. Now again, if this is something that you want, make sure you click the link in the description of this video, apply to work with us, get on the calendar ASAP, and we will see if we can get you back any money for some missed deductions that you might have had.